Hey everyone, Anthony Venuto here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, I want to talk about the Bank of Canada's upcoming rate announcement on the 26th of January, as well as what it means if they increase interest rates sooner than later, and what it means if you have a variable rate mortgage. Stay tuned, we're going to dive right in. Once again, I want to take this opportunity to thank all our continued supporters and viewers of the channel, as well as our Instagram, Facebook, and Finance Fridays videos. We appreciate everyone's comments, feedback, and DMs regarding questions, as well as future topics. So thank you. We encourage everyone to continue, sharing and liking our videos and passing that information along to people that may benefit from what we're talking about, especially as financial literacy is a major concern for us here in 2022. And when it comes to real estate and mortgages and anything in between, as we see home prices, creep up to highest levels they've been in record history in Canada, as well as inflation, trickling up there almost to 1990 levels, we're seeing a lot of stuff moving and shaking in the market. And, it can be sometimes hard to disseminate some of that information. What does it mean if the Bank of Canada increases interest rates? What does it mean if I have a variable rate mortgage? If I have a fixed rate mortgage, what does it mean if I'm looking to go out there and buy? There's a lot of questions that people are asking, especially when it comes to real estate and mortgages. So what I want to do is just talk about a quick couple of things that are important to understand about the Bank of Canada and its potential to increase interest rates sooner than later. So obviously, you don't need to go too far between social media, the news, where you have conversations being had about inflation being an all-time high. It's been basically 30 years since we've seen inflation this high, and that was back in the 1990s. So for many young Canadians who maybe, are millennials that were born in the 80s and 90s, they haven't experienced inflation like this. Our parents potentially have, our grandparents for sure, back in the 70s and the 80s. So I'm going to dive into this quick article just to sort of give us a little baseline of what the conversation is. And obviously, there's a lot more content out there that you can definitely read. I always advise clients to, and people, if they're looking to get information, subscribe to one of the major news outlets. There are subscription services. They're worth every penny, in my opinion, if you're looking to gain some further understanding, especially with their opinions and economic outlooks. So this is an article that says inflation rate hits 3-decade high as Bank of Canada interest rate hike looms. So basically, this is a very interesting article because as we see, it discusses many of the major push factors when it comes to why prices and inflation have gone up, what we see happening, what basically, you don't necessarily need to read this article in order to know that prices have gone up. If you go to the butcher, if you go to the grocery store, you're seeing prices go up. 2, you might be seeing things that are not even on the shelves, depending on where you're shopping, gas, shelter. These are all products of what's called the Consumer Pricing Index. These are all things that are in that. And when you start to look and see that, items like shelter, food are increasing significantly, that is a major concern for the Bank of Canada. They need to address it. This is basically the chart that I was saying, since 1990, you saw inflation at almost 7%, and now we're just hovering right below 5%. As of December, it was 4.8% up, from 4.7 in November, and we should have data coming out in maybe the rest of this month to see exactly next month what's the January CPI looking like. But obviously, it's gone up, and we're feeling it. So, if you simply look at articles like this that talk about, consumer pricing index, not factoring into real estate as well, because real estate home prices are getting out of hand, and the Bank of Canada does have their finger on it. But keep in mind, the Bank of Canada's main focus, although the housing market is one element of it, their goal is to keep inflation at 1 to 3% range in order to keep Canadians and affordability there, right? That is their target. So very high level stuff. Bank of Canada is focusing in on inflation. Now, there are external pressures coming from your top 6 banks, as well as your Canadian Mortgage and Housing Corporation, for the Bank of Canada to increase interest rates to help cool off this housing market, to make things a little bit more affordable for Canadians, as the idea or the dream of home ownership for many is starting to, being pushed out or basically non-existent. So the Bank of Canada is basically, stuck here in a rock and a hard place because they do have to look at the economy. They have to look at inflation. Can the Bank of Canada, by increasing interest rates, fix supply chain issues? I highly doubt it. All they can do is curb enthusiasm or curb, people in spending. As you increase interest rates, people will tend to put more money towards either, paying off debts or putting more money aside. And, there's many elements when it comes to real estate. Obviously, too many to mention in a short video. We'll leave that for the extended podcast where we can have an in-depth conversation about it. But what I did want to do is basically say that potentially on the 26th of January, the Bank of Canada is going to be in a position where they might be increasing interest rates sooner than later. And what does it mean if you're in a variable rate mortgage? Because that's the question that we get asked all the time. So I want to dive into just a quick little payment analyzer. And before I do that, what I want to do is just basically bring your attention to the fact that, mortgage amounts can change and vary from province to province, person to person, house to house. So the numbers that I'm using right now are very generic, very high level, but just to give you an indicator or just highlight some of the differences and exactly how much money you could potentially be looking at when it comes to differentiating between a fixed and a variable rate mortgage. So if you take a $600,000 mortgage at the current 30-year rate of 2.89%, rates are hovering anywhere from 2.89, 2.79, 3.09%, depending on your institution and depending on your lender on a 30-year mortgage. Obviously, this is not insured, so there's no insurance premiums. This is basically maximum amortization with conventional banking. Your payment is about $24.8863 every month. Okay. So, fixed rates have gone up over the last little while. We just saw a rate increase this week and last week. So major banks have pushed up their interest rates for, conventional mortgages and insured mortgages. So we're using just a generic rate. Obviously, you would need to speak to your mortgage professional in regards to what rates are offered to you. And this is basically, you're looking at around $2,500. Now let's just basically take a look and say, if you were in a variable rate mortgage and you were able to get it, let's say at 1.50%, obviously there's rates that would have been a lot lower depending on when you got your variable rate mortgage or when you renewed. But just for simplicity purpose, we're going to make it, same $600,000 mortgage with a 1.5% interest rate. You're at $2,070 a month, $2,069.38. And, obviously you can see you're significantly lower. You're over $420 roughly less expensive per month. That's a huge amount of money in a difference between locking into a fixed rate mortgage. And that's why a lot of Canadians are opting to go into the variable. But if I want to bring your attention right here just for a quick second, when you look at it and say, okay, let's say if the Bank of Canada increased interest rates by 0.25%, your $2,070 payment would go to $2,140, would basically go up $70. And, you are looking at it and saying, okay, if it goes up $70, you're still well below the $24.88. Let's say it goes up let's say the Bank of Canada, over the next year, raises it to 2% and, another 0.25%. So 50 basis points, your payment goes to $22.15. You're still $250, $60 cheaper per month. You can see between $24.88 of 2.89 and 2% on your variable rate mortgage, you're looking at it and saying, hey, it's $22.15.23. So basically, and even if the Bank of Canada was to increase it, let's say 4 times from the 1.5 to let's say 2.5%, that's 4 increases. Your payment's still cheaper at $23.66.70, and you could be potentially seeing 4 increases into maybe 2023. So what you see here is just a conversation about it. And obviously, we're not leaning anyone in towards a fixed or a variable. This all comes down to your appetite for risk and what helps you sleep at night. Because if, taking a fixed rate mortgage is going to give you a better night's sleep and you're not going to be worried, it's like all investing in stocks. If, you want to be safe and sound and you want to basically sleep at night. For those who are a little bit more risk adverse or people that are actually a little bit more in a different situation, maybe the variable rate mortgage is a better option, because it doesn't leave all the money on the table. But I guess the messaging that we're trying to convey with the Bank of Canada meeting on the 26th with a potential rate increase around the corner, it's not a matter of if, it's a matter of when, and Bank of Canada will be increasing interest rates. How many times, we don't know, but is to understand not to panic, because as you can see from the numbers, locking into a fixed rate mortgage at this current environment, you're going to be leaving money on the table and you're going to be paying more towards interest than towards principal, rather than let the, variable rate mortgage, see what happens over time and, start looking at it, depending on where you are in your mortgage, where you are with your rate and where you are in, your maturity. Because obviously looking at locking into a fixed rate mortgage now and not taking into consideration, a future move, renovation, refinancing, paying out some debts, you need to understand that you will be paying a penalty to get out of that fixed rate mortgage as opposed to the 3-month going on a variable rate. So variable rate, once again, 3 months interest to get out of the mortgage on most products, most good products, and fixed rate interest rate differentials. So we saw this happen in 2020. A lot of clients started to panic at the early onset and locked into rates in mid 3%. And then we saw what happened. Rates came back down, housing went up, and people decided to move and were paying hefty, exorbitant penalties to get out of their mortgages. And what we want to do is basically advise that, if the Bank of Canada does increase interest rates, you have to understand the economy needs to be able to absorb that slack. It needs to be able to support it. And, I'm not saying that things are going to change. If they increase interest rates, they're going to have to bring them back down, but only time will tell, as, the Bank of Canada and, these decisions need to be absorbed by the economy, the markets, the stock markets. And if things start to go amiss, the Bank of Canada will have to basically come back and pull back, interest rates and potentially, maybe stimulate, provide, print a little bit more money. We don't know exactly what's going to happen, but the messaging that I would advise to all our clients out there, as a message is don't panic. Let's see what happens. Let's look at your payment amount and see if you're willing to lock in at a higher rate, put more money in the bank's pocket, or keep more money in your pocket. Because as I said, with a variable rate mortgage, you might have to look at 4 or 5 times before you're at the same rate that you're locking in for a fixed right now. And that's a lot of runway to leave on the table and to give to the bank. So obviously, if you have any questions, concerns about your mortgage, we're always here to help. Our team is here to help you at any given time. So please feel free to reach out to us here at In Touch Mortgage Solutions. It's Friday. It's Finance Fridays. Thank you again for tuning in, and we'll see you next week.